Hello, everybody. Welcome to the Daily Covered Caller. My name's Max. I appreciate you being here. We're going to talk about these high yield funds that I like to talk about so much. All right. Hopefully everyone's doing well today. The market's doing a little better than it was yesterday. So let's start with the old heat map. So, it's improving. It's not as green as it was yesterday, to be sure. The market's reversed a little bit in the last hour. It's pulling back a little bit, although the indexes are all up. They aren't up as much as they were. Nice to see Bitcoin recovering. Commodities taking it on the chin. Gold, silver, crude down, as well as fixed income. Fixed income is really taking on the chin. TLT has come back to earth. For a while, TLT was on fire, I tell you what, but it's coming back to earth. I don't think this little bout of volatility is over yet, personally. I think it'll pick up again soon. Just my opinion. All right. So here's the reason I think that. So here's the VIX term structure. We talked a little bit about this thing yesterday, but I'm going to start showing it every day. Basically, think of it as like looking at the market's EKG, or maybe it's like looking at the market's blood pressure. It won't tell you for sure when the market's going to have a heart attack, but when the VIX term structure is elevated and looks funny, if this was the patient's cardiogram or something, I'm telling you, the doctor would be concerned. A healthy patient would be, the line goes up and to the right, where the future is more uncertain. These lines right here, this term structure where the current futures prices for volatility are higher than the future, that's called an inverted term structure. And that is usually a sign that volatility is in the market. And once the market settles down and the term structure goes back to normal, then it's a sign you can go back to buying every dip. That's the way I use the term structure. So we'll look at it every day here. So all right, so here's one of the worst. Here's one of the sickest patients ever. This was the historical term structure from 2009. So think about that. So if you were more uncertain about something that's going to happen this month than you were about something that's going to happen 240 days from now, and by a magnitude of double the uncertainty, that shows you that there's a problem in the market. Sure enough, that was at the height of the financial crisis when things were blowing up and people's margin was getting called, and the whole world financial system was on the brink of collapse. But keep an eye on this term structure every day. It didn't get this way in one day. It became elevated over several days. So it'll give you a warning. That's what I'm trying to tell you. Okay, so look at this. So let's do this. Let's put it in for yesterday. Get prices, multiple dates per graph. Okay. Oh, that's August 6, 2008. I was going to say, that's a good looking chart. That's not yesterday's. That's a healthy patient right there. That's what a patient looks like when they're still healthy. That's yesterday's term structure. That's the day before's. That's the day of the big. That's the day of the big pullback. That was Monday, August 5th. August 6th. This is Tuesday's term structure. So it's settling down. The future is still more uncertain than the past. So that's still a Houston, we have a problem situation. Now let's go to the previous date before that. Even the date before that, it was kind of warning, hey, something's up. Okay, now that was the last day I would say the term structure wasn't inverted. So that was August 1st. But August 2nd, or I'm sorry, August 2nd, 5th, August 2nd and 5th, it was screaming at you, hey, there's something going on here. So anyway, we'll start looking at that every day, or especially every day whenever the market's going down. If the market recovers again and starts going up, that'll be boring to look at because it's going to look the same way every day. Okay, but we're going to keep an eye on that. Like I said, I wouldn't be surprised if this sell-off's not over. After I get out of here, I'm probably going to get puts for next Friday or maybe this Friday. But anyway, I'm going to maybe get some index puts. I don't think the selling's over yet. And not a lot of them, just a little bit, just for fun, 5 or 10. Try to make a couple $1,000s. Nothing crazy. But I just don't think. I think there's a little bit more money to be made on the downside. All right. Let's see here. So let's look now at the charts. Okay. Well, speaking of the charts, you can see the market open. The NASDAQ opened, went sideways for a few hours, and is now coming down. But you can also see the profit box. We're still max profit on the triple QY. So that's great. Right now, let's look at SPX so we can check out how JEPY is doing in relation to the profit box. They should still be above it also. Looks like I forgot to draw it this morning. I'm sorry about that. But had I remembered to draw it, they would be above it. Let's look at the spreadsheet for our backup. I could have sworn I drew that. I got the other one. All right. 220, 270. I'm going to draw it really quick for you guys. All right. Well, anyway, you get the idea. That's the break even, or the top line's max profit. So that's what we're really playing for right now, which is also the strike price, which is 52.70. You don't even have to worry about profit boxes or anything else. Just always root for the puts to be above whatever the strike price they sold that day is. Anyway, these guys sold the 52.70. As long as the SPX is above 52.70, right now it's the 52.92, you're in good shape. Okay, so now we'll check out the Russell. I think I drew the one for the Russell, which is IWMY. Okay, I did. Now, this one was interesting. These guys, and I'll ask Jay about this, these guys sold an out-of-the-money option. Usually they sell an in-the-money option. So the reason that profit boxes are green and yellow is because the in-the-money amount of the option is in green. So that amount is also the amount of NAV they're able to capture in an up market. That's why we keep track of them separate. The yellow part of the profit box is what pays the dividend in every market, but it pays more of a dividend in a down market because the yellow parts, and the green parts for that matter, expand as the markets pull back. So anyway, these guys are above max profit, but they have no intrinsic capture today. It's all extrinsic. They sold an out of the money option for some reason, because the market was right here. See, it was at 2063, and that's usually when they sell, or they sell right at the close. The market's at 2063, but yet the option they sold, the strike price was the 2055 for some inexplicable reason. I'll be sure to ask Jay about it. I checked twice to make sure it wasn't my mistake. I went and re-downloaded the daily trades, and it said 2055. So they sold here's what they did. They sold the same strike as they did yesterday. But yesterday, the volatility was a lot higher because they received $32 to take the same risk as they only received 24. So anyway, but it just has zero intrinsic. But the good news is that intrinsic doesn't matter if all you care about is the dividend. It had hella extrinsic. Speaking of extrinsic, look at this dividend. This dividend's $1.73 right now. And that's in old shares because I can't think in new shares yet. But in new shares, it's going to be $5.19. That's insane. On JEPY, funds losing money for the month. It's down 55 cents even after yesterday's big recovery and today's recovery so far. But dividend estimate's at $1.11. That's insane also. The 334 is what it's going to be in the new shares, but post split price. And triple QI, $1.47. That's huge. $1.29 is the biggest I remember, maybe $1.20. Now, the other side of it is these guys are down 44 cents a month so far on trading results. It's been a rough month trading. They've had a $2 million loss, a $4 million loss, a $3 million loss, and a $5 million loss. But they've had a $3 million win, a 2.7 win, and a $2.4 million. They're winning 2.4 right now, earning 2.4, I should say. All right. So let's look at USOY. USOY, we're rooting. They have all their eggs in one basket. This one that I highlighted in yellow, they sold the 75 strike for $2.59, but it expires today. So even without a profit box, all you need to know is you're rooting for USO, which is the underlying USO right there, to be at least, or to be 75 or above for max profit, or to be no less than 75 less 259, which is 72.41. You're rooting for two numbers, 75 and 72.41. Don't even need to worry about the profit box. You can just do those numbers in your head if you want. But if you're watching the report, it does help sometimes to visualize it. Now, this fund was in trouble a few days ago. It was losing money big time on Monday. It was, well, I don't know, big time, but I was worried about it whenever the market was selling off. But anyway, the market's fully recovered as far as USO goes. We'll see if this stays up. Like I said, we'll see what happens. But this expires today, so these guys should be in pretty good shape for today. I mean, I think these guys are in good shape. Okay, so now, what do we want to look at now? Let's look at the buffer report to check out some of the yield. Well, I really don't have any yield max names in the buffer report. Let's just check out whatever I do have in the buffer report. Oh, no, I've just remembered. I don't think you can see the buffer report because of my freaking PayPal thing. I'm so sorry. I should just hide that. All right. Okay, so what's going on in the buffer report? So Bitcoin pulling back. Look at Theta. THTA is finally popping back to life. It had a THTA, ZIVB, and SVOL had really, really rough days the other day. I should put them all together. I should put them next to each other. There's ZIVB and SVOL. Okay, now, but look at ZIVB. ZIVB bouncing back hard today as well as SVOL. These are the short volatility funds that short volatility implicitly and directly and really, I would throw THTA in there as well. They do it in a different way, but it's the same thing in my opinion. Anyway, they're all recovering today, and I really do have a great video coming out on the three of these funds. And I promise I'll do it today. I discovered some new stuff yesterday, so I made the video longer. So it's going to be kind of a long, in-depth video on how these short volatility funds work, but and what causes them to blow up, and do I think they're going to blow up, and what would it take for them to blow up, et cetera, et cetera. So anyway, be looking for that. I really will record it today. I promise. All right, so let's see what else is. Let's see what's doing well. Let's talk about the good stuff. USOY, we just talked about that. Look at that, catching all of the upside of its parent asset plus a BIP. That's beautiful. I really like this fund, Riser. I haven't talked to you guys about it, but I like that fund. You guys need to get you some of it. RISR. My good buddy. He's not really my good buddy. I spoke with him once. I just like him. That's why I always call him that. But the boss at Tidal, Mike Venuto, he is one of the sub-advisors. I think this is kind of his baby, or partly his baby. But anyway, I talked to him a little bit about this fund in New York. I'll do a full report on it someday. But anyway, that's kind of an unsung hero fund, in my opinion. All right, iSpy. Look at iSpy killing it today. ULTY bouncing back. That's really nice to see. In index land, really, I mean, everything, this is back to like a normal day. Things are outperforming their parent on the upside. And that's what we would expect when it's the high-powered funds, especially like Bally and GPIQ and GPIX and this one, iSpy for sure sometimes. The high-powered ones, ZIVB is what I would call a high-power. Yeah, they outperform their parent on the upside. The ones that have a lot of buffer, a little bit safer on the downside, like JEP-I and JEP-Y, should be performing a little bit worse than the parent, or quite a bit worse than the parent. They're supposed to have buffer. They don't have as much as I'd like to see. So this fund right here, triple QT, getting about 25% less downside. That's pretty good. You want to see about 25 to 30% less downside in these funds that don't get a lot of upside. That's usually what you get out of JEP Y and JEP I. It just depends on the market, though. Anyway, it's a good day today, but it doesn't offset the other day's ugliness. Even yesterday and today doesn't offset it. So let's look at some charts here. Let's look at a daily. I just think it's important to keep things in perspective. In this time frame, I usually start from the daily time frame, make a bigger opinion in the daily time frame, and then drill down and execute that bigger opinion in the smaller time frames. I'll show you how. So I don't see, to me, I play Bollinger Bands, and so when it's on top of the Bollinger Bands and going up and trending up, I'm bullish. And when you get a close or two closes in a row underneath the Bollinger Bands, not to mention 4 or 5 closes out of 7 days way underneath the Bollinger Band, pretty good sign of that you need to be short. Anyway, but so in this time frame, I wouldn't be interested in getting long until you get above the Bollinger. They have miles to go before they get above the Bollinger Band. In this time frame, even if it rallies up to here, it could still be a sell. It could still be a sell, and probably will be, in my opinion. But so in the daily time frame, I'm still bearish because it's nowhere close to looking for buys. But then you can drill down in the 30-minute time frame and try to find bearish setups. So the way I would find that in the 30-minute time frame, because it's quicker, is whenever the market sells off and you get a close under the 30-minute Bollinger Band like we had here, and then especially if you get a second in a row, a confirmation close, it's usually a pretty good sign to get short. And it worked there, it worked there. Now it didn't work here. It didn't work here, but you made so much money on these 2 days. You did fine on these 2 days, but then you lost money on this day. If you're just trading the 0 DTEs, which when you're trading the 30-minute time frame, you're only trading. I'm only trading 1 or 2, maybe 3 days out. But see, the reason it got on the top of the Bollinger Band and issued a buy signal here, right? The reason I didn't take it is because in the longer time frame controls it, and the longer time frame is still super bearish under the 200 moving average, trending down. The longer time frame, that's the hourly, especially the daily, still super bearish. It just looks to me on the daily like we're bouncing to read. I would look for us to get no higher than about 5,300 or so, and then I bet we turn around and I bet we're just retesting the place we broke down from. And if we can't take it back, it'll look like, oh shit, the bears are right, and then it'll be look out below. And the next time they'll take out this low, the most recent low, and I think they'll aim for the 200-day, which is right about 5,000 right now. So my option trades for next week are aiming at the 5,000 level. Just FYI, in case anyone's interested. Okay, so now speaking of that, let's go to the comments. I wanted to read some comments. I'm going to cover up the guy's name just because I don't want to embarrass him, or I didn't ask him if he could use. Anyway, but I was hoping that somebody took me seriously when about 3 weeks ago I was saying, hey, this market's going down. It's going to, I was trying to get people to hedge. Anyway, but one of my subscribers wrote me and he said that he didn't hedge, but he bought puts 3 or 4 weeks ago, which is when I was talking about it. He didn't say it was just because of me, but anyway, great minds think alike. And so but I'm happy somebody got a piece of that. He got puts for New Year's Eve, which were the same ones I had, 20% out of the money, and he doubled his money last week. That was anyway, that was for me with the weird stuff the yield curve was doing. It was pretty obvious to me something was gonna. There was a bunch of hints that something was coming. Like I say, I don't think it's over yet. I just don't. Anyway, we'll see. It could be over for now, though. Excuse me. Let me get a drink. let's see if I had any other things I wanted to share. This was a good one here. Okay. This one, this person said, my concern is the Defiance funds have a NAV hemorrhage. I sold them all off. You can have great dividends, but what about the NAV? Moved into Roundhill, weekly dividends with stable NAV. The reverse split concerns me. And then one ETF evaporated. I will be buying FEPY as well. We need a stable NAV and stable dividends. And I said, I thought you guys might be interested in my reply. I said, I hear you. I need stable NAV too. So you can have stable NAV in a 9% return with an ETF like JEPI, the JP Morgan Covered Call Fund. It's a great fund. Or you can have a 45% yield with JEPY, but you get a side of NAV appreciation with that order. It's going to come with it. All right. So it's your choice. So what do you do? Is there a right answer and a wrong answer? Well, not without being able to predict the future. There's not a right answer and a wrong answer, but there is math. All right. And math can bail us out. So let's see how would we compare the two funds? Which one do we want? The one that pays 45, the one that pays 5 times as much monthly, but has NAV decay, or the one that doesn't have NAV decay? It actually does a little bit, but whatever, but doesn't have as much, whatever problem with the NAV, and it pays 1/5 as much. Well, what's the right thing to do? Well, so then I followed up. So the first thing to consider is, do you need income? Are you retired or disabled? And do you have maybe $500,000 or maybe $1 million or more saved up that you could invest in these funds to replace some of your income? Because these assets are meant to provide an income. They're like a CD or a bond or even a rental property, but more like a bond. But in the fact they're like a rental property, also they're passive income. You get paid on it once a month. And rental properties, it's also, let's look at it this way first. It's meant to provide an income. And the CD or bond's a better comparison. But these income funds should only be used for a portion of your portfolio anyway. Even if you have the $500,000 or $1 million, you are disabled or you aren't going to work anymore, but you've saved up enough where you can afford not to work. So, you have some assets. Even in that case, 20%, I'd say no more than 20%, because these are fixed income investments. And normally you have a normal responsible thing to do is to do 60% in equity and then 40% in fixed income type things like CDs, bonds, maybe even real estate, REITs, that kind of stuff, or covered call funds. But since these covered call funds they do have a little risk with them, I say don't use that whole 40%. Just use 20% of that allocation. So if you have $1 million or even $500,000, but you have money saved up and you aren't going to work, so you need the income. Yeah, heck yeah. But if you can have a job, you're much better off, instead of buying triple QI, to buy triple Q, just normal non-covered call ETFs. Work, save up another 10 years, then retire, and then get triple QI. That's the way that's the best use case for them. The use case for trading is not a good use case. So let me read the rest of my thing. I said, okay, I say no more than 20%. But if you're buying these hoping to double your money in 6 months, these won't make good ETFs for you. Go buy something leveraged and trade it if you want to make a lot of money. But don't forget, there's a lot of risk with that type of investing, timing the market and using leverage. But that's how you make the big money. If you're trying to make big money, these are not for that. But the alternative is you could put 20% of your $500,000 in these types of investments. Don't worry about the NAV. Just focus on the total return and cash these monthly checks they give you and make it where you don't have to work in retirement. You're able not to work in retirement. That's the idea. You can't work all your life. So your assets need to produce growth while you can work. And then after the time where you can't work, you can convert those growth assets into income producing assets. All right. But for actually making the $500,000 or $1 million or $2 million in the first place, for growing and accumulating wealth, these don't make good investments. I'm with you on the stable NAV. I get it. Everyone wants that. I do too. But there's ways to deal with that. And just realize lots of times when you get the funds with really stable NAV, they sometimes don't have very good total return. But I mean, so you have to, so here's the way we solve that problem. So let's look at JEPY, the super steady JP Morgan fund that pays 9% lately or something, which is nice. And then we'll look at JEPY, the really badass Defiance fund that I love so much that pays 45% or so lately. So let's see, let's go back. Well, let's just go since inception and see which one's done better. Okay. So choices. So I always look at the bottom. I never factor reinvesting dividends. That's a good thing to do, but it makes the math unpure. The bottom one just factors taking the dividends in cash. So it just takes extra variables out of it. So look here, JEPI, the super steady fund that only pays a fifth as much dividends, actually did not as perform as well. You're actually leaving money on the table. You could actually make 45% and get better total return than a supposedly stable NAV fund. Now look at this. It's true that JEPI's NAV is stable. It started at 55 a year and a half ago, or not 8/10 of a year ago, 9/10 of a year ago, almost a year. Started at 55, still at 55. Stable NAV, that's great. JEPY, on the other hand, it started at 60, now it's at 44. Holy shit, that sucks, right? Well, the thing is, you have to factor in that it pays 5x the dividend the other one does. So that money has to count for something. When you add up that money and you account it for something, they're still pretty close, but JEPY's beating it. And I've been watching this. JEPY's been beating it all year. JEPY is just a really good fund. I mean, and this is just a good example of a stable NAV fund. Now, there's other stable NAV funds that are beating JEPY. I'm not saying JEPY is the greatest fund ever, but it is a good fund, and it's an example of a fund that pays a huge freaking dividend and still has excellent total return. You know. All right, so let's do this now. Let's go back to here, see if there's anything else we could talk about. All right. Well, anyway, that's fine. I think we covered enough for today. I just wanted to catch up on some of those comments. All right. So earnings. Let's see what we have earnings coming up. So after the bell today, before the open, we had Disney, CVS. After the close, nothing really that interests me. I mean, I like to look at Zillow, but okay, the big one tomorrow is Eli Lilly. That's just a mega cap. Who else do we have tomorrow? Really, the earnings week was last week. The big earnings week was last week. Tomorrow after the bell, Gilead, Take-Two Interactive. Anyway. All right. Yeah. Earnings is starting to slow down. All right. So let me, I'm going to go right now. I promise this is some of my content on the, I'm getting ready to make a video on ZIVB, SFOL, and THTA, those funds that explicitly and methodically short vol. And we're going to look at how bad they blew up the other day. And we're going to see if I think they'll do it again or what. All right. All right, guys. So be looking for that video. I promise I'll actually get it out today. You guys have a great day. All right. See ya.